All right, let's jump straight into this explainer. Today, we're popping the hood on North America's energy infrastructure giant, Enbridge, breaking down their Q1 2026 financial reality, that massive capital backlog they've been building, and what Wall Street is forecasting for their future.
Here is our roadmap. We are going to cover everything from their historically consistent dividends to their actual Q1 results. Then, we'll unpack their $40 billion growth engine, weigh the bull and bear cases, and wrap up with their outlook for the rest of 2026.
Starting off with Section 1, Decades of Dividend Growth. Because in the energy sector, consistency is absolutely everything.
I want you to really think about this number. Enbridge has been paying dividends to its shareholders for over 70 consecutive years. I mean, consider all the economic cycles, the energy crises, and the market crashes over the last 7 decades. Through all of that, their payout has just been an absolute constant.
And it gets better, because they aren't just paying it, they're actively growing it. Over the last 30 years, that dividend has compounded at an average annual growth rate of 9%. 3 decades of nearly double-digit compounding. That is literally how you maintain dividend aristocrat status.
So looking at right now, they've just announced a 3% bump for 2026, bringing it to $3.88 annually. But here's the really crucial part. They are smartly keeping their payout ratio between 60 and 70% of their distributable cash flow, meaning they're not starving their business to pay their shareholders. They are keeping enough fuel in the tank for future growth.
Which brings us to Section 2, the Q1 2026 financial snapshot, the ultimate reality check. Okay, there is a fascinating contrast here. GAAP earnings are sitting at $1.7 billion, which at first glance looks like a dip from last year's $2.3 billion. But hold on, look at the adjusted EBITDA. It is standing remarkably strong at a massive $5.8 billion, right on par with last year. And distributable cash flow, that actually ticked up a bit to $3.9 billion.
Now, don't let the financial jargon scare you. For asset-heavy beasts like Enbridge, you've got to look at EBITDA and DCF to get the true pulse of the company's operational health. It strips out paper accounting factors like massive pipeline depreciation. DCF is literally the hard cash they have available to pay those dividends we just talked about.
All right, Section 3, the $40 billion growth engine. Knowing that cash flow is stable, where exactly is all the future growth coming from?
Here is your answer. A $40 billion secured capital backlog. Let me be clear, this is not a wish list of maybe projects. These are commercially secured. Management sees this monumental backlog as their absolute primary vehicle for durable, long-term value.
Just in the first quarter of 2026 alone, they tacked on another $2 billion to this backlog. And think about the spread here. You've got a 300-megawatt onshore wind project in Texas, which is actually backed by Meta to power their data centers. Then, massive natural gas expansions at Tres Palacios, Vector Pipeline, and the Dawn Hub. They are definitely not putting all their eggs in one basket.
It is a textbook all-of-the-above strategy. You've got critical, conventional natural gas pipelines running right alongside huge renewable investments. It's a smart, dual approach to North American energy delivery.
Moving to Section 4, bulls versus bears. Let's step back from the physical assets and see what Wall Street is thinking.
The debate is drawn pretty clearly down the middle. The bulls, they absolutely love the infrastructure setup. They are pointing to forecasts that project a massive 29% jump in natural gas demand. But then you have the bears, and they are raising their eyebrows at an elevated 5.0x debt-to-EBITDA ratio. Yes, management says that's within their target range, but with rising interest expenses, bears have actually been trimming down their future earnings forecasts.
But here's the kicker. Even with those totally valid debt concerns, listen to the consensus. Exactly 50% say strong buy, and the other 50% say buy. There is literally not a single hold or sell rating in our data right now.
Finally, Section 5, the 2026 outlook. Let's look at the horizon.
Enbridge is holding very firm on their 2026 guidance. They are projecting up to $20.8 billion in adjusted EBITDA and distributable cash flow between $5.70 to $6.10 per share. But the real headline? Post-2026, they are explicitly staking their claim on about 5% annual compounding growth across the board.
So what does this mean for the stock price? Well, comparing the current price of $55.32 to the Wall Street consensus target of $66.50, analysts are currently modeling roughly a 20% upside potential. Which brings us to the end of this explainer, and I want to leave you with this one pivotal question. We know the 70-year history, we see the solid Q1 cash flow, but will that $40 billion secured backlog actually be enough to bridge the gap and consistently deliver those ambitious 5% growth targets post-2026? It's all going to come down to execution. Thanks for joining me today, and definitely keep that question in mind as we watch how this plays out.